Hello everybody, this time we are talking about solvency. Solvency is the ability of a company to meet its long-term debts and financial obligations. Solvency can be an important measure of financial health since it's one way of demonstrating a company's ability to manage its operations into the foreseeable future. The quickest way to assess a company's solvency is by checking its shareholders' equity on the balance sheet, which is the sum of a company's assets minus liabilities. And then we move to assessing the solvency of a business. The solvency of a business is assessed by looking at its balance sheet. The balance sheet of the company provides a summary of all the assets and liabilities held. A company is considered solvent if the realizable value of its asset is greater than its liabilities. It is insolvent if the realizable value is lower than the total amount of liabilities. The cash flow statement also provides a good indication of solvency as it focuses on the business ability to meet its short-term obligations and demands. It analyzes the company's ability to pay its debts when they fall due, having cash readily available to cover the obligations. The cash flow also offers insight into the company's history of paying debt. It shows if there is a lot of debt outstanding or if payments are made regularly to reduce debt liability. The cash flow statement measures not only the ability of a company to pay its debt payable on the relevant date, but also its ability to meet debts that fall in the near future. A solvency analysis can help raise and red flags that indicate insolvency. It can uncover a history of financial losses, the inability to raise proper funding, bad company management, or non-payment of fees and taxes. And then we move to objectives of solvency analysis. The first objective, risk assessment. Identify potential solvency risks such as excessive debt levels, declining profitability, or inadequate cash flow to proactively mitigate them. And then second objective, regulatory compliance. Ensure compliance with regulatory requirements, including capital adequacy ratios and debt governance, to avoid legal and financial penalties. And then third, long-term planning. Formulate long-term financial strategies that enable negotiations to meet its obligations and achieve sustainable growth. And then fourth, capital allocation. Locate capital efficiently by understanding the organization's financial capacity for investment, debt servicing, and dividend distributions. And fifth, investor confidence. build and maintain the confidence of investors, creditors, and stakeholders by demonstrating the organization's ability to honor long-term commitments. And then we move to the key characteristics of solvency. The first characteristic about asset liability balance. Solvency will depend on the total amount of assets with respect to total liabilities. The company whose liabilities are less and assets are higher is solvent. And then, second, long-term focus. Unlike liquidity, which focuses on current obligations, solvency is more concerned with one's capability to meet debt and other operational needs for long term. And then the third, financial ratios. Solvency can often be measured using specific financial ratios, such as the solvency ratio, debt to equity ratio, and interest coverage ratio. And then we move to how to make a strategy to increase solvency. To increase solvency, companies can take several steps, such as the first, reducing debt. By reducing the amount of debt, a company can increase its solvency ratio. And then second, manage assets efficiently. Good asset management, including selling unproductive assets, can help improve solvency. And then third, increasing equity. Increasing equity capital through the issuance of new shares or reinvestments of profits can improve solvency. And then finally, we move to the limitations of solvency ratios. While the solvency ratio can be an important indicator, there's one area in which it isn't quite enough. It doesn't consider the possibility of a company acquiring new funding sources over the long run, and for example, bond or stock funds. This is why it is recommended to use it in conjunction with other types of analysis to provide a thorough overview of a company's solvency. Another limitations of solvency ratios is their inability to tell us how much capital a firm has, which is not true for all companies. There are other ways to assess the solvency of a firm, and one way to measure this is by examining the company's liquidity. By measuring the firm's liquidity, we can determine how likely it will survive in a tough economic climate. Another way to choose a firm's solvency is to look at its probability of achieving different rates of return. Often, these measures are examined under the broader category of risk. I think it is enough. Thanks for watching. Thank you.